trading floor located in the heart of BGC Taguig. One thing I
Welcome everybody,
wherever
you are
located
in
in
the
the heart
world,
of
to
BGC
another
Taguig.
episode of the Trader Cafe. This is a show where we interview people from the world of trading to help learn about what motivates them and drives them to succeed. So during this series, we're going to be talking to traders, some market observers, and market analysts to bring you insights into how to go about improving your trading edge. Now, my special guest today is me. However, what we're going to do, because me talking to myself would be a little bit strange, we're going to ask Ainsley Clubb, who, as all of you know, is one of the senior Actions to Wealth traders, to facilitate the discussion and ask me some questions to me, which makes life slightly more interesting. Otherwise, everything just happens in my head. So welcome, Ainsley. How are you?
Julie, I'm well. How are you?
I'm very good, thank you. And there's a beautiful picture of the lovely city of Sydney in the background. Sad that you guys all having to stay indoors for the time being, because I'm sure the weather's not so bad outside. But hopefully soon you'll be allowed out into the world. You'll be grown up enough to go into the world.
Yes, they'll let us out. But yes, we've been in lockdown, unfortunately. But unfortunately, it's a really, really nice day in Sydney for a day in winter. So 20 odd degrees and sunny. And we're in lockdown. So it's great. It's all good. But yes, I'm glad I could be here and help facilitate you not sounding quite so batty asking yourself questions. That's really good. So we can move along. So let's get going, because I know a lot of people are very interested in your background and what you've been doing and how long you've been doing it. So give me a little bit of a spin on how did you get started? How did you get started in trading?
Great question. Without revealing some days, I think as you get a little older, revealing your age gets a bit more frustrating. So, look, I've been trading for about 30 odd years or so, and probably a little bit longer than that if I should really sit down and think about it. And my background is like I've had three, I guess, parts to my career, right? Sections to it. The first, I was an investment banker, and I began my trading career in the fixed income, in the bond markets, right? Yeah. Where we traded European government and corporate bonds. Then I spent the second bit of my career having left the investment banking industry, going to work for some hedge funds and some family offices where I was a proprietary trader. So my job was to make money, an absolute return trader as they're called these days. So, if I underperform on the year, I don't get paid. If I make more than, if I'm above zero, if you like, then I get paid for that. So it's a bit of a eat what you kill type of thing. And with that, what I did, I guess, for about 12 or 14 years. And then I came to New Zealand, and I then joined a energy company and learned all about the power markets and the emission markets. And that gave me another, if you like, fascinating change of direction for me to learn about how the world of energy and emissions works. And of course, right now, front and center, the world is changing very quickly, and decarbonisation is part of that process. You need electricity and you need carbon emissions to sort of achieve it. So that's that's the other space that I work in. But throughout all of that, throughout my whole career, I have been, and I will remain, a macro trader. I do it for a hobby. This is what I do. And I've been doing it for so long now that I don't tend to think too much about it anymore. So thank you. I hope that helps the listeners and the viewers to get a feel of who I am.
Well, that's how you got started. So straight away, you started as the investment banker. And I guess, look, would you say trading today has some similarities and some differences?
Oh, wow. Yeah, look, that's a fantastic question. Yes. Well, the number one thing that I didn't have was something called the internet. So we can't do this, right? The concept of a teleconference, who the hell thought of this 30 years ago? Okay, you maybe saw it on science fiction movies, on Star Trek. Now it's reality, and some days we have to pinch ourselves how fast we're moving. Yeah, look, the internet was there, wasn't there. So I had to rely on something very strange. I had to rely on something called a book. So this has bits of paper in between some covers, and you have to sort of open it up and read it. It's really strange. A bit old-fashioned. Some people apparently still use them, but most of the world doesn't because they end up listening to shows like this. But yeah, look. So I learned through osmosis and through. I tell you what, I learned the hard way, as I like to call it. Right. So mine was a trial and error process. I didn't have somebody like Actions to Wealth or even shows like this being able to sit on my shoulder and really help out my trading journey. Right. This was literally saying, okay, right, blank sheet of paper. How do I do this? Okay, well, I know I need to buy and sell things. Right. That's for sure. And I need to buy something, and if it goes up, I make money, and if it goes down, I lose money. Okay, I know this sounds a little bit simplistic to people, but believe it or not, you've got to start somewhere, right? And so then you go, well, what's my philosophy? How do I do this? So I started to read books about price action, and the only books on trading that were out there were ones written by floor traders in Chicago. So that's where I learned all about price action, about market profile, about something called open, high, low, and close on a bar, and something called a candlestick. This candlesticks were a bit new.
That would have been new technology.
They would have been, and as you can see in the background, they didn't have a red and a green colour in those days either, right? So literally, it was a starting from scratch. So what I had to do was to figure out what made markets tick. Now, for me, in the early stages, you lean on what you know best, which is the price in front of you and how that changes, right? So you essentially become a tape reader. They used to call a tape reader many, many moons ago. What that means is that you're just looking at prices all the time to try and get a feel for what happens, and that develops into an open, high, low, and a close, and then you try and interpret what's going to happen. And the markets weren't 24 hours either. They would only open for the commercial sessions in each of the cities that you were in. And those cities didn't talk to each other. So when you had a chart, when you had a chart of foreign exchange, the foreign exchange chart would be London hours, right? And that would be it. The rest of the time you sort of make it up. And when you're trading treasury bonds, you trade just US hours, and European bonds would be European hours, right? So you'd have all these breaks. So every day there'd be an open which would be significantly different to the previous day close because something would have happened, right? So this is why you learn about, well, what does that mean? What does the overnight session mean? That's the sentiment-driven element of the market. So all of those things, were in the mix. And it was a little bit like the Wild West because you're sort of trying to make stuff up, as you go along. And you're thinking, well, don't even get me started on risk management. That didn't really exist. Nobody knew how to manage risks. There was no theory about risk management. There was nothing.
That's interesting in itself, but going back to the ticker tape that you basically were reading and watching an open, high, low, and close, I guess you would say that was you watching, in essence, price action.
Yeah, 100%. That's exactly what it was.
There were no indicators or fancy charts or anything like that to look at because there was no internet back then. So price action was the be-all and end-all.
Yep.
So today, is price action still your predominant entry?
Oh, look, that's a really great question. So the short answer is yes. Look, I'm all about the price. I don't think I can ever get away from that. I think what was the expression somebody came up with the other day? Yeah, it was really funny. I was looking at a Twitter feed from a prop trader in Chicago I follow, and he just tweeted, right? This is all he said on his thing. He said, "Be dumb, follow price." And I thought, brilliant. I wish I could find a better way of putting that, right? But I think that sums it up perfectly. Look, if the price action is going up, you want to get long, right? If the price action is going down, you want to get short. That sort of makes philosophical sense, right? We haven't got into the concept of a breakout or anything else, right? But let's just think about what that means. And providing you have the momentum, then that strategy, just even that simple strategy, tends to work quite well. Now, these days, is the market different? Well, of course it's different. Do we have more visibility? Yes, of course we do. We have a 24-hour market. All those things are different, right? And as a trader, you've got to adapt. But at the end of the day, in order for price to, if you make any money, price has to go from A to B, right? It can sit still, but we're not option traders here. So we don't really want it to sit still. So you say, right, it's got to go from A to B. That's either up or down. and I want to try and be on that trend when it happens. So that's held with me forever.
So what is one of your favourite setups? You're looking at price action being your predominant driver for trade selection. But what is it? What's your favourite setup? Because, you know, we look at multiple patterns and charts and all the rest of it. What works for you? What hasn't worked for you?
Yeah, look, I'll explain why in more detail, but the favourite setup for me are market failures. So what do I mean by that? I mean when the price is sitting in a trading range and it breaks the downside, right? Now maybe that's a reinforcement of the previous trend. Let's go with that theory, right? So this is a new trend starting in the line with a big overall big picture trend, right? So when that happens, you go, okay, great. So this is a breakout. And then what happens is the market quickly reverses back on itself and goes straight back inside the trading range again. So I call that a market failure, right? So what's happened, it's not a market failure, but what happened is a price failure, okay? So what's the price tried to go down, couldn't manage it, and got bought back straight away. So what information is that telling you? That's telling you that for the time being, you've put an extreme price level in place, right? So that may be support, it may be resistance. It doesn't really matter, right? And what that does is that then gives you a marker to trade against. Now, the reason why I like it is we get into this risk management stuff. So thinking back 30 years ago, I went, oh, okay, that's a failure. Right, I know how to trade that. I can put a stop loss in vaguely somewhere near, if it's a low that's been put in place, somewhere near the low, and I'll try and buy it if it starts to roll back into the range again. Okay, great. But I had no sense of the asymmetry of what I was doing, right? These days, when we have such sophisticated risk management tools, we can come up with asymmetry calculations. And this is where, you know, as a trader these days, I'm more patient, right? Because you say, I'm going to wait for the asymmetry of the trade to turn up that really suits me. So think about this another way. I'll explain it. And I say, look, 1-to-1 doesn't interest me. I need 2-to-1. I need 3-to-1. How do I create a 3-to-1? Well, a price failure is a perfect example of how you can create that asymmetry, right? Because you get 3, 4, 5-to-1. Now, what does that mean statistically? Well, then you get into the complicated stuff. In the old days, I just saw a price reversal and jumped on top of it, right? So now I've tried to quantify that in more sophisticated terms because we have the tools, right? But that for me is by far and away my favorite setup because the asymmetry works so well. You know, you can get 4, 5-to-1 really quickly. And I mean, you're in the market for a short period of time usually. You know, you're either right or you're wrong pretty fast, right? And as a result of that, you don't have to spend too much time leaving your capital at risk. So you can often do it sometimes during the day, but usually within 3 or 4 days, you can actually turn 3 or 4 times quite easily.
You mentioned it a couple of times, and I guess it's now very much front of mind and part of your trading strategy profile. Risk management. So can you elaborate a little bit more on that? You didn't have it to start with, but now you've mentioned it every time you talk about going into a trade. Risk. Elaborate on what you mean by risk management. Is it, you know, you're talking about entry stop loss target, or are you talking about risk capital or risk exposure, or what is it? Because I've actually learned that risk is not just that little bit from entry to stop loss. There's a lot.
Exactly. Oh my God! So look, it's the whole thing. What you've described, it's everything you've said and probably a little bit more because there's now a science. So walk back to when I first started in the 80s and 90s. What do? You sit down there and you go, okay, I've got an account. Somebody's given me some money to trade. I'm going to. I don't have to think about margining the account because I worked for an institutional trader, so I didn't. Somebody else did that in a different department. So my job was purely to think about price. So how many do I buy? Well, I don't know. They just make up a number. There must be some risk involved in it somewhere, but let's just make up a number and we'll go and buy some. Because if we make X, Y, Z, then okay, that seems like a reasonable amount of money to make. That was all the risk management I used to deploy. Now, when people start out in trading these days, they probably actually sort of feel the same to some extent, right? Because, you know, look, it's all very confusing. And so, you know, I know Paul has a specific model for the traders to think about how they manage it and put, you know, a certain percentage of risk on board. But in those days, we didn't think about any of that stuff, right? But
you didn't have to. Somebody else did.
Exactly, and to some extent, they're just somebody else was just measuring it. All they did was measure it. Nobody said, okay, well, you can't do X, Y, and Z. I don't recall they even had a limit to start with. So when you get into these discussions, right, you go, okay, well, then that feels like the guy today. And I think that the people starting out, I would always say when you start out trading these days, I would start with the risk management. Understand what that means, right? I am going to risk 1% of my capital on this trade. What does that mean? And the reason why I think it's so valuable, right? Because there's actually a really good rationale behind it, is because when you say I'm going to risk 1%, psychologically, I want you to feel as a starting out trader that you've lost that money already. Okay, I think this is a critical part of trader development. You've got to write the money off and say, that's the investment, I'm writing it off. If I make money out of this trade, then that's awesome. The logic is that when you first start out in trading, you may be profitable. You may be one of those guys who's tapping out the Bible on a typewriter, right? We all know those stories, okay? But what's probably going to happen is you're going to initially struggle because, God, this is confusing and there's a lot of jargon and, oh my God, really? Can't they just make it simple and tell me buy here, sell there and stuff like that? I know Paul's guys do an amazing job at Actions to Wealth, and this is, they're awesome at it. But even so, you're having to absorb you have to absorb an awful lot of information, right? So when you think about it, I think the best way to think about risk management as a starting out guy, say, right, 1% is written off. Now, that's one element of it. Then the second element is to say, well, look, if I start to make money, yay! If I start to make money on the trade, what do I do then? Because where do I get out? So where's my exit? Oh, Julian said, if you're looking at price failures, you've got to look at 2 to 3 times. Well, of course, I'd said that because that's roughly what they work out to be over a long period of time. Any individual trade, you've got to figure it out. You need your support and resistance, and you've got to look at targets. And, oh, my God, what's a target? How do you work a target out? Okay, right, now you see some of the problems, right? So this is important. And then the third part, which is probably by far the most important part of all the other parts of risk management, is to think about how much money you're making, right? This is, you got to manage your account. So what the last thing you want to do is to go into drawdown, right? That's nobody wants a drawdown. Everybody wants zero, right? It was a shit month. I made, sorry, I did swear. It was a bad month. I made nothing. I came out, but you're a trader, and most importantly, you're a levered financial trader. I'm afraid zero as an outcome is outstanding. Do that after 3 years. That's awesome. Okay, but in all likelihood, you're going to have a negative month. These things happen, right? Sometimes and then I'll expand on this a little bit, right? How you are defined as a person defines how you handle that drawdown. So team, everybody out there. Now, Ainsley's that way, right? Where are you? You're over there. God, I hate trying to do this on the thing. You're sort of over this direction, right? Everybody, look at Ainsley. This is a lady who can handle a drawdown when it happens.
Not well,
okay. Find me a trader. In all seriousness, find me a trader who can. They don't exist. Even Stanley Druckenmiller, when he loses money, I bet you he goes looking for the cat, right? So
I've got a treadmill. When I get on the treadmill, I get the beating. So I found
exactly. But honestly, learning how to handle those drawdowns is so super important, and they always come at the most inconvenient time. And then there's another thing: why do drawdowns come at the most inconvenient time? It's because when the market has performed well, what happens next? It stops performing well, right? Otherwise, markets would always perform well. So consequently, when the market's been performing well for some time, you get excited. I'm on a roll. This is brilliant. Then it stops performing, and then you start to lose money because you go, yeah, this is great, bigger size. I'm in this now. I'm a trader. I really can do this. Oh no, I can't again. Right? So
being bulletproof isn't helpful.
Yeah, exactly. This is the challenge that everybody has, right? And it all comes down to this, team. This is what it's about. Now, we can all go on a Tony Robbins course and we can learn to be resilient. We can learn to be able to push through it. We can do all of those things, which is lovely words. However, trading is one of those activities that for some strange reason, it's really hard to apply those psychological positive vibes until, funnily enough, you get validation. So what has to happen is you've got to sit there and roll it out, right? Ride it out, ride out the losses until they start to come back. That's the trick, okay? So it's that persistence.
The mental resilience that you've got to build up. And it's so easy. And you hear it all the time because you hear, especially with actions to wealth or anything to do with trading, the number of people who will tell you this doesn't work, it's a scam, and they've given up because it's beaten them. But the market doesn't lie, it keeps rolling, it keeps going. But the mental stability and the mental psychology that you've got to get a handle on will beat you every time. But coming back to the market cycles when the market is performing, when do you know to step on the gas? When do you know you're on a roll? When do you know to take advantage of that? And when do you get out?
That is, I think, the question.
It was three,
okay.
But yeah, okay.
Yeah, so, look, so team, what Ainsley has asked me, right, is when things are going well, how do you push harder, right? So what do we mean by push harder? Well, if you're trading your own money and you traditionally say 1%, is there a time when you can get some extra performance from doing 2% or 3% maybe? Okay. Or scaling into a position by taking multiple positions in the same commodity, maybe for different reasons, right? So, let's say you have a moving average crossover system that gets you long. My favorite anti-system. So, please folks, so the track record of moving average crossover systems using standard moving averages is pretty appalling. They work brilliantly when they work, and when they don't work, they're appalling. So, we can do better, right? But anyway, right? So let's say you get long because of that, right? You then find yourself sitting on coming down to a major support level as the trend is up, right? And say, great, I'll take a second position here. And then, then you maybe drop a time frame. Same principle applies, The key thing about this, right, there's two aspects to it. So you can either trade bigger size or you can trade multiple positions. One of the, two of those things. So the key thing is this is about stepping on the gas. So how do you know, right? How do you know that this breakout is the one? So the question is, with hindsight, or not the question, the point is with hindsight, everybody does, right? I do, Ainsley does, we all do. Yeah. We could all look back at the screen and go, oh my God, of course it was going to go up, right? We all absolutely know that, right? But the trick here is that tomorrow or the next trading bar, we don't know that. We're just guessing. So we have to rely on a method, and our methods hopefully get us there. Okay, so what tends to happen is the experience of trading, and this, guys, is if you're starting out, this is where you need to do your chart homework. Don't just rely on a trading system, he says, metaphorically and physically banging the table, right? Don't just rely on a trading system, okay? You can't. Yes, have a trading system, I agree with that, because it gives you some stability and some sense of predictability about when it trades and what it does, and providing you understand the philosophy of it, and that's awesome, right? But, and here's the big but with this, right? You've got to have the ability to press from time to time. So in order to do that, you've got to understand what's going on in the market. In order to do that, you've got to look at a lot of charts. You've got to get that experience as fast as possible. How do we do that? Well, you could listen to us talk about markets at TTR on a Sunday night, right? You could also listen to other people. You could also do your homework. There's umpteen different ways of doing it. The community is enormous now, right? There's plenty of places to go for helpful advice about what is going on. But the reality is that's all just helpful advice, and I would prefer to do my own homework. At the end of the day, that's what I like best, is do my own homework. And then that experience will give you those times when it's time to put your foot on the gas.
Okay. So I'll share a bit of my homework that I was given out by my coach. You, and it was getting in front of the chart, scrolling all the way back as far as your charts would go, and then bar by bar by bar advancing and seeing the patterns develop, repeat, and what they were going to do and how far they typically move in the main commodities and FX assets that you would normally trade in. So when I was starting out, being a master, trying to get across all of those was just too much, and we whittled it down to a few, and then we added a couple of commodities. And again, you maybe go back to the beginning of the chart and go back through every bar so I knew how that commodity would move. And now gold and oil are a bit of a favourite of mine, but that's because I've gone back and done my own homework. And you can listen to people and all the rest of it, but I found that, to me, your instruction to me, which was go and do the homework. It's boring as batshit, but you've got to do it. And you will only absorb it and then believe what you're seeing by doing it yourself.
Exactly. By the way, this is how you help build a system, right? Because if you go back and you will recognize patterns as they come out,
yeah.
right? Very, very quickly, you'll recognize a pattern and go, oh, that's a ring low. Oh, that's a price failure. Oh, that's a breakout. You'll recognize those patterns and see what happens. Some markets have idiosyncrasies. Many of them are just exactly the same, but with slightly different volatility structures. But But the key thing is, and Ames has nailed this, right? How do you do it? Oh my God, because you're going to come back and say, Julian, there are 420 foreign exchange markets. And I'm going to go, you're absolutely right, there are. But tell me the ones that are the most important. Tell me the ones that everybody in the world looks at those exchange rates first when they pull up their foreign exchange screen. We are not talking about Mexican peso, Mexican peso yen, right, as a cross rate.
Your top six?
So there are 6 top markets. So in the foreign exchange space, you look at the euro against the dollar, so euro-dollar, and you look at dollar against yen. Now, why are we doing those 2 exchange rates? Well, because one is America to Europe and the other one is America to Asia and vice versa. You may want to look at euro-yen, but that's just a derivative of the other 2. So when you follow those 2, they've got to be absolutely in your mind. And I would say to everybody, you've got to learn those exchange rates and those charts so you know those 2 charts off by heart, right? Because at the moment, the dollar yen is going up. It's been going up pretty much all year, right? Interesting. Okay, why is that happening? Because Japan's supplying the world with capital normally. So why is dollar yen going up? Okay, so interestingly, it's because the Japanese are buying bigger and bigger and bigger positions very clearly, right? They're selling yen and they're buying dollars, right? There are some trade flows, but the money flows outweigh them all. So what's gone on in the euro? Well, if you look at the year, the euro has done sort of well, but reality is it's also gone sideways. I believe it's gone sideways pretty much for, God, how many months on end, Ainsley?
The euro?
This year it has had a range of 123 to 119. Whoopee-doo.
Yeah.
Okay, however, right, 4 big figures. It has, if you swing trade it on a weekly chart, gone up and gone down, and okay, great, and you may have a system that does that, right? Brilliant. But those are the charts to know. You've got to know those 2. Throw in a couple of other charts, right? Throw in gold, throw in oil. Well, that gets you to 4 now. Now it's starting to get squirrely. So what else do we need to see in the world to tell us what's going on? Well, you need an interest rate in there somewhere. I'm not talking about Fed funds or anything like that. You want to look at the only interest rate that matters, which is the 30-year US Treasury bond yield, because the Fed doesn't interfere with that one, right? That is everybody else's thoughts about what's happening. And then finally, you can't exclude them because we love them to bits. You've got to put some equities in there. Okay, so then we look at the S&P 500, the greatest index in the world, right? And the most liquid and deep index in the world, right? So then that's our 6. Guys, know all of those, right? Think about it, learn them. Do the training that we talked about, going back and doing the replay on the charts, however you do it, just tabbing through day by day, hour by hour, whatever you want to do it. Do your training on those 6. Learn how they work. Learn how they behave. Absolutely critical. Really, really important.
Okay, so they're your little nuggets, but what else do you add on top to your trading? What other peripheral stuff? So we've got the price action, and then we've got the price action on your top 6. We've got a bit of risk management. What else do you add in there to give you a bit of a bias, to give you a bit of wind behind your wings that you sort of go, okay, we're looking good here. What else do you look at?
Yeah, look, it's a great question. The short answer is I had a couple of other things. I had cycles, I had some seasonals, and one or two other features as well too, which is probably not worth mentioning. So the key thing for me here is I like a little bit of conditionality. Now, why do I like it? Well, I know that the core price action methodology I use is about 60% successful. And you know, at the very beginning we said, guys, get used to drawdowns, right? Well, when you have a 60% successful system, interestingly, it's weirdly more non-linearly more successful than a 55% one. I know it obviously is 5% more successful, but actually in reality it isn't. There's some weird maths behind it, but let's move on. So the key thing is, with 60% successful, 40% of the time you are going to be unsuccessful, you're going to lose money. That 40% might be a month, it might be a week, it might be a day, it could also be a quarter, right? And so this is what you've got to try and bear in mind, right? So if your methodology is sound, and most methodologies out there are pretty sound when you get when you try and get a handle on them, you're not trying to make a little incy-wincy bit. You're trying to make a move, and the philosophy is right. I'm trying to buy it. Hopefully it goes up. Sell it, and hopefully it goes down. It's all we've got to learn how to do a short, right? So those things, right? If the philosophy is right and you're at 60% successful, you go, okay, providing I'm better than one-to-one risk-reward, I'm going to make money. So the logic is that over the course of 18 months, I'm going to make money. I'm going to be successful. However, success to you in your mind is not what success is to a system like that, right? Because it might not be enough success. Most people in their walks of life, so that's why sometimes doctors struggle a little bit with trading, is because they're not used to failing.
Yeah, they've got to be right.
They have to be right 95, 98, 99, 100% of the time, right? As many other walks of life, you have that exact same thing. Ask an accountant how the books balance. They can't be 60% accurate on it, right? So here's the thing, right? This is the problem that people get hung up about because they can't conceive what 40% unsuccessful looks like. So anyway, what I try and do is I try and lift my edge by a few percent. If I could get to 70, then that's a rock star. Guys who are statistic people out there, thank you, run the spread, still not going to say it, run the spreadsheet, right? Run the spreadsheet about how the return on your account works, right, off some kind of random number generator, the difference between 55% successful, 60% successful, 65 and 70, and you see what happens. And then you realize if you can lift your game by 5 or 6%, it makes a massive difference. So what I look at is I look at the cyclical pattern of the market. So markets go through cycles, both based on the calendar months, but also based on a certain repeating rhythm that they've had in the past, right? For those of you who are really interested in the out there stuff, you can look at the orbits of Mars and things like that, right? There's a cycle, right? The moon, right? The full moon is often seen by some people as being a change of trend.
I know.
Okay, so,
I thought that was a bit of a. I heard you mention that a while ago, and I just thought, he's completely lost it now. And then I did some research into it, and it actually seems to have some credence. It
does. And so I think this has got something to do with the weather, for the record. I think that's where it all comes from. And the weather, if you think about it another way, people feel better on a rainy day, on a sunny day than they do on a rainy day.
I do.
And therefore they're more positive. And as a result of that, they're more aggressive. You could spin that line into a fairly sound argument if you sat down for a little while and thought about it, right? The collective hive mind, right? So anyway, the point is, what I'm trying to do with this is to give myself a little bit of extra room. And it's remarkable. Seasonals essentially are patterns that repeat year after year. So there's a seasonal pattern in gold, a seasonal pattern in oil. Gold, we're just about to come into that seasonal pattern. We've got three or four weeks to go, and then gold starts to really get turned on. Guys, wait till the show tomorrow night, Ainsley. I'm sure we'll talk about the seasonal pattern coming up in gold. This is going to be interesting this year because gold, of course, has come down, right? And everybody thinks it's a great inflation hedge, and therefore, when you hit the seasonal button for gold to go up, then what does that mean? Now it's a lot cheaper than it was 6 weeks ago or 3 weeks ago, right? Anyway, we digress. But there's another seasonal pattern in oil as well too. So from about October time, oil generally, maybe September time, oil generally takes a big tumble. And when it rallies in the first quarter of the year. It seems to do this every single year. Now, you will say, the skeptics will say, oh, come on. This is in the market. Everybody knows about it. So it's been arbitraged out. But then go look at the chart. And this is where we get back to price action again, right? Why does it keep repeating then? If everybody's arbitraged it out, why does it keep repeating? Is it not also the case that everybody knows about this and wants to buy it as well? That is also a view. So what I try and do is always to give myself that little bit extra edge.
That's great. So going full circle, what would your philosophy of trading be?
That's a great question.
I've stopped you.
Yes, you have. So my philosophy.
You're not an aggressive trader. You're not a. You are technical, but you also do a lot of fundamental trading, and you seem to wrap it all up into one. Put a big bow around the whole lot of it. With your edge, you look at what is your edge. You know, your selection, your timing, your trade management, your risk management, all comes into that. So putting that all together, your philosophy would be that you're a what kind of trader?
I have always wanted to be consistently successful.
That is a fabulous outcome.
So when I think about trading, I always think about it from the private trader angle, right? And actually, to be honest with you, from an institutional trading point of view as well too, if you only make money 3 months of the year as an institutional trader, you have 9 months of the year where everybody hates you. So, you know, the concept of making money constantly is a really good one. I've been really fortunate in my career. I think I've only ever had one down year, right? And that was a tiny amount of money. However, during that time, if you go back and look at my returns during that time, of course, I've had drawdowns during those years, but they always seem to come back. And I've been fortunate that way. But things happen. I think the reason why I hesitated on this is I've morphed a little bit. So I've learnt to become patient. And again, I'm going to quote you from a guy, you know, Twitter, the great encyclopedia of philosophy in the world, as you well know.
Of course.
There's a great trader called Tom Cranfield. I think his handle is Canny4, and he's a private trader. Guys, I recommend you follow him because he's awesome about his philosophy. He said the other day, the impatient pay the patient.
Oh, every time.
And I think what you've got to do, hence the reason why I was hesitating on answering you, is you've got to learn to become patient with your style. Create something that works for you. Number one, you can't do this, right? You can't do this. None of this works, right? None of all this talking about the fancy risk management and all the other stuff. None of this works unless you've got a style that actually is successful. So find something that's successful. Now, either you've acquired it, because after all, you know, we all know the gig, right? You're either buying it and it goes up or you're selling it and it goes down. And now, you know, we can talk about optimizing it a million different ways. And there's probably about 100,000 indicators out there to help you with that process. But at the end of the day, what you're really doing is you're buying it and it's going to go up, and you're selling it, it's going to go down, right? That's it. Okay.
Or staying in the market, third option.
Yeah. And again, if you've got the ability to trade options, which is another whole discussion world and everything else, right? So then you love markets that go sideways and are boring, right? Oh, by the way, if you combine both of those strategies, it's incredibly powerful. So, but that's discussion again from the day.
Another one.
The key thing is to actually have that set up first, then roll the psychology, roll the risk management into it, and somewhere in there throw some timing at it, right? And then you're there.
Yeah. So basically, figuring out what works best for you, because we're all different.
100%. Yeah. Look, and actually, I'm going to go further than that. I'm not young, but I figure that every 5 years I have a change of thing. right? And I'm sure it's the same for you, Ainsley. You have a change of thing every 5 years, right? Vaguely, right? It isn't. I don't know. Let's say it's 7 years, whatever. It doesn't matter, right?
You know, if you change, maybe evolve, because you start seeing things a little bit different that you either were so focused on with something over here. You tend to evolve. I think evolve is probably well. And if somebody's starting out, they can't expect to cram 10 years of experience into a couple of months and go, hey, presto, I've got the hang of this.
100%, absolutely correct. And look, we're all at different parts of our lifestyle. When, you know, if you're a young guy or a young girl and you've just left uni and you've got absolutely zero responsibilities, right? Then you can sit down there for 24 hours a day and learn. Okay. But life doesn't work like that. You will not be having no responsibilities until the rest of your life, right? That's not the way the world works. There'll be a period of time when the cycle will shift. You may meet somebody, get a partner. You may, adopt or have children. You may not, right? And then when you have kids, there are life cycles around having children. You know, the pre-teens, vaguely, the teenage years. Oh my God, strap in. And then the post-teenage years where you're trying to kick them out, right? Before, oh my God, what happens is they get married, they have their own relationships and their cycles carrying on. Then you have grandchildren. The list goes on, right? We all know, and we're all at a different part of that cycle, right? So what you got to do is to find out how trading works for you within each of those cycles too, because I have changed the way I trade, mainly because I've been doing it for a very long period of time. And I've got a lot of experience, but equally my life has changed, and therefore I've changed my style with it. You know, I don't day trade anymore. However, in fact, the length of time I'm holding my trades for, especially when I'm buying equities now, is actually much shorter than it ever used to be. I would hold equities for weeks and weeks. The other day I bought Coinbase and sold it within 48 hours. Unbelievable, but it went up 15% in 48 hours. You're going, well, oh my God, really? Come on, that's like a good year.
Are you saying velocity is the rate of movement has exponentially accelerated over time?
I think that what's happening is the market environment today is telling you maybe in some market sectors you've got to trade shorter term.
Yeah.
Right? I don't think that's the case in FX. I don't think it's the case in interest rates. I do think it's the case in equities at the moment. I really think short term is it. I don't know about day trading, but I understand but very short term trading where you're holding things for 2 or 3 days, absolutely. I think that seems to be the way. And we all know how volatile cryptocurrencies are. So there you can hold things for an hour and make 5%, right? Which is insane, right?
Always
so
insane.
Yes. Positive. So
yes, always.
And she is, for the record. I still can't do this. You're over there. The point about it is that you've got to learn that environment, right?
Yeah.
The environment suits you and suits your style, and you've got to have the experience of being able to match it to the environment. What you do not want to do is to say, I don't care about the environment, I have my method, I'm just tapping away and I'm taking trades and I have no regard whatsoever for whether the market is in trend or chop mode, whether the volatility is high or low, whether the environment is going to change or transform itself anytime soon, because I'm just doing the same thing with my trading system. That,
very adaptable.
I think is a little bit naive as to the way the world works.
Yeah. So yeah, it's times are changing, huh? Or as you've shown, as you've seen over the last 30 years, times have changed, but still a lot stays the same, and still got to put the hard yards in to get the return.
Yes, I think the French have many great expressions around this, right? Plus de change is the obvious one, right? So the key thing here is that Ains is absolutely correct, guys. Look, the environments are always shifting, but they shift in a cycle. So what we're seeing now in equities, we were seeing in equities back in 2000, right? Now, I know some people weren't even born then who were coming onto this show, right? But I was around in 2000. I remember it dearly, right? And it was an absolute crazy time. You know, everybody I know was making a fortune out of all these companies that they didn't even know. I remember, well, pets.com was the classic one, right? You know, nobody understood what they did apart from maybe send some pet food out, but they didn't know how to do that because in those days online ordering hadn't been developed, right? So it's like, oh my God. Anyway, the share price went up, you know, hullabaloo, and then collapsed, and, you know, they went out. I think they got absorbed or whatever it is. Somebody bought the IP of the system. So the point is, right, crazy times, we're back in crazy times in some of the stock market again. Now, I think we're probably coming to near the end of that process because we can see the volatility is starting to be taken out of the market in some certain sectors. You know, maybe cryptos come off the boil, maybe the meme stocks have come off the boil, you know, and certainly I think some of the post-pandemic internet stock run-up has come off the boil, right? It's more to do with real economy these days. But it doesn't matter, right? That environment is shifting, so shift with it, right? Do not get stuck. That's the key thing. And as a trader, if your philosophy works, all you need to do is overlay the environment with it, with your risk management, understand that price action really is how every market works. Literally every market in the world, once it has a price and it starts to move, that's called price action. You know, and they all do the same because actually it's run by humans, and even where it isn't and it's run by an AI, it's still programmed by humans, so duh. So you've got this whole thing, right, whereby it just repeats itself in slightly different ways. Understand that some of the keys to the kingdom are just you know, right there for you.
Yeah, there is no particular holy grail, but yeah, it will all come to those who wait. Well, Julian, we have been going for over 40 minutes, and look, because I couldn't help myself, it's my turn to give you rapid-fire questions.
Do it. Let's do it.
Okay, let's go. The tables are turned. I think we were talking about this show being called In Hot Water. Hello. So let's start. Ready? Where do you see Bitcoin at the end of the year?
45,000.
45. Okay. Who influenced your trading the most?
Larry Williams.
What is the most important character trait you see for a trader?
Resilience.
Uh-huh. Yeah, that's a good one, I've got to say. Got to be resilient. You've got to hang in there. Favourite trading book or movie?
Favourite trading movie for me has to be Trading Places, simply because I'm old.
I've got to go watch that one. I'm not that old.
Yeah, I think it's not in black and white. They do have a colour version with Eddie Murphy in it.
Favourite financial asset to trade?
Oh my God. I grew up trading trading treasury bonds. I think if I had to go and trade anything in my life ever again and just be given one market to trade, I'd choose treasury bonds again.
If you're in an eating contest, what would you choose to eat?
Pizza.
Oh, that's not gluggy or hard or easy to eat.
Stuffed crust, pizza, probably pepperoni, because after about, let's not go into what would happen after about 10 minutes, but I suffice to say, I've got a sneaking suspicion there were a number of people on the Actions to Wealth team who will comfortably beat me in a speed eating competition. So I'm very confident in whatever I choose. I probably need to grab some protein in the process, because otherwise it's a waste of energy for me, because I know I'm going to lose.
Yeah. And my last question, if you weren't a trader, what would you have been?
I would have been a management consultant dealing with companies that have got themselves into financial difficulty. I'd be the recovery specialist.
Holy moly. Julian, thank you very much for your time and answering our rapid fire questions. So just to give you a bit of a who's who in the zoo on that side of the screen. And that wraps it up for another Trader Cafe episode.
Ainsley, thank you very much. You've been an amazing host. I really appreciate you taking the time out to interview me. It's been an amazing experience. I've thoroughly enjoyed myself today. And to everybody out there, thank you very much. And if you have been, as always, thank you very much for listening.
Thank you very much. See you next time.
Cheers,
Bye.
folks.
Cheers, everyone. We're going to wind her up there. Great to see Julian answering those questions. So there's some really good stuff there. If you are, if you have a chance to go back through it and watch it again, I would really recommend that you do. You know, those years of experience can't be bought. You know, that kind of stuff. So, yeah. Cheers, Claire. You're more than welcome. I thought it was brilliant. And look, Julian and Angie recorded that the other morning, so that the questions that we've had, unfortunately, they can't answer today. But Julian's back, I think, next week doing Q&A with the client base. I think it's Q&A with the client base next week. You guys will have a chance every month. You'll have a Trader Cafe, a Q&A with the client base. He does a Q&A with the staff, and he does a macro market overview. Either way, next week you'll have a chance to ask some questions. Thanks for joining. I do hope you've enjoyed. We'll see you in the Sunday market update in about 10 minutes from now. The Sunday market update in about 10 minutes from now. We'll see you there. Thanks for your help, Mai. Cheers, everyone. Thanks for joining in. Thanks to Julian and Angie for that. That was awesome.